The volatility that energy markets went through this year in 2022 has some describe it as the truly first global energy crisis, strained by an economic rebound from the pandemic, insufficient investments, and geopolitics and sanctions. Energy markets underwent a substantial crunch this year. These developments present us with a number of pressing questions. Will this crunch endure into 2023 and beyond? Will energy security trump energy sustainability? Are we in the midst of an historic moment where a new energy map is being redrawn? Who better to try and grapple with these big questions but Dr. Daniel Yergin, the author of the new map and the vice chairman of S&P Global. Dr. Yergin, thank you for coming on the show. Taking stock of the turbulent year that is 2022, has the energy crisis derailed the energy transition, or will it eventually prove to be a catalyst for the required policy initiatives and investments needed to provide solutions for delivering sustainable, reliable, and affordable energy?
I think the answer is both in terms of the response to the crises of 2022. On the one hand, energy security is back on the table, and countries are working very hard to ensure that they have conventional supplies. At the same time, it is definitely a boost for renewables. We're going to see that step up, legislation in the US, plans in Europe. But I think even as the effort is made to enhance energy security, people are also looking at it in terms of carbon footprint and be more efficient in the use of energy.
But Dr. Yergin, is it safe to say that 2023 will continue to witness an energy supply crunch and wild swings in energy prices?
Well, we're just at the beginning of 2023, so how the year will play out, there will be surprises. I mean, who at the beginning of 2022 thought there would be a massive Russian invasion of Ukraine with all the consequences on the energy market and a transformation in Europe's energy policy and energy directions. With that said, I think that the risks are certainly there as long as this war goes on in Ukraine. But at the same time, I think what we see is that the big question is what's going to be the impact of the high interest rates that the interest rate increases that the U.S. Federal Reserve and the others are having, and I think that will weigh on the oil price. So, expect volatility? Absolutely.
Well, speaking of Europe, the EU is spending billions of dollars on long-term natural gas deals and building infrastructure such as new LNG receiving terminals and new interconnector pipelines. But at the same time, Europe is asking Africa to use its fossil fuel or not to use its fossil fuel resources in its national development plans. Double standards, would you say?
Well, I would say that there's a new north-south divide, and it is very striking to have European countries asking Africa for more LNG, but refusing finance, and their banks refusing finance to develop natural gas pipelines so that people don't have to cook with waste and wood. And that's why in the new map, I really focused on this question of a new north-south divide in which the priorities are very different between the developed world and the developing world on climate, on energy, and on meeting the needs of growing populations.
Well, you've also added a new chapter to the book on the U.S.-China relations. These relations have ended the year somewhat on a less negative note, given the face-to-face meeting between Biden and Xi Jinping at the G20 summit sidelines. Will this change anything with regards to the ramifications of the U.S.-China strategic competition on the global energy markets?
It's not just the global energy market, of course, it's great power competition on all dimensions, try semiconductors, military, trade. So it permeates everything, including energy. Although the irony is that China is a significant importer of energy from the United States right now, particularly LNG. I think the meeting in Bali was a very welcome development. It maybe lowered the temperature, which had really gotten quite high earlier in 2022. And I think basically the most important relationship in the 21st century is the relationship between China and the United States, and anything that can be done to reduce the tensions, the very evident tensions, is a contribution to global stability.
This year, it seems that clean hydrogen has risen to the fore as the fuel of the future, not least in policy circles, from the EU Repower to the IRA in the US. How do you view the developments for hydrogen this year, and is it closer to be put on track to fulfill its touted potential?
Well, I think you've captured the change. I mean, everywhere I go in the world, wherever it is, companies are focused on hydrogen, governments are focused on hydrogen, and huge excitement about it. To me, it still seems that it's early days. There's definitely a hydrogen business, but it's not a hydrogen energy business. And it'll take 2 or 3 years to see where we get to it. And one of the things I hear again and again, I hear it when I'm in the Middle East, I hear it here in the United States, is it's one thing to produce hydrogen, but where's the market for hydrogen? Who's going to be the consumer of hydrogen? So I think the next 2 or 3 years will be really determine what kind of role hydrogen can play. But there's sure a lot of resources and a lot of managerial attention and a lot of engineering going into hydrogen.
Dr. Yergin, the EU and G7 sanctions on Russian crude, including the price cap and the upcoming sanctions on the 5th of February targeting Russian oil products. Is it really feasible to shut Russia out of the energy markets, do you think? And at what cost?
Well, the EU would have shut Russia out of energy markets with a ban on shipping and insurance services. And so the price cap was really invented as a way to keep Russian oil flowing, but at a lower price. And at least so far, to the surprise of many, it seems to be working. Russian barrels of its mainstream of oil is selling for like $45, $47 a barrel, at least right now, which is well below the price cap. And so I think it's also given countries like India the ability to negotiate lower prices. But you do point to a very important factor, which is the February 5th target on products. And product markets, particularly diesel, are much tighter than the crude market. And so, this one seems to be working, although clearly Putin continues to attack it and criticize it and threaten to cut production. But I think the products ban and the price cap on products will be the real test of this very unprecedented structure that's been imposed.
Well, Dr. Yergin, the sanctions on energy is absolutely a weapon that has been wielded this year in an unprecedented way, just like you say. What will the implications be, particularly for oil trade flows? Are we witnessing the global energy map being redrawn, and will the global oil market as such become fragmentized?
Well, I think 2 things to say. I mean, energy is being used as a weapon. Russia is using natural gas as a weapon in Europe by basically cutting off supplies of natural gas to its most important market with Europe. And that has created, of course, great hardship right now in Europe. But I think it means longer term that Russia has just slammed the door on its own most important market for gas. And it's going to be much harder to redirect its natural gas than to redirect its oil. But in terms of a new map, to use a phrase, we're seeing I think we've gone from a global oil market, which is what really resulted after the end of the Cold War, the collapse of the Soviet Union, in which, with some exceptions, Iran being one, oil investment, technology, all flowed pretty freely around the world. I think that's come to an end now, and I think we're into a new era of what I'm calling a partitioned oil market in the way that you described. So supplies are being redirected. Middle East supplies are going to Europe in much greater volumes. But it does mean that the era of a fairly free-flowing global oil market has been replaced by this partitioned, this divided, or to use your phrase, fragmented global oil market.
Let's talk a little bit more about the oil market. The oil price has witnessed a significant drop in the last couple of months. It seems recessionary fears are in the driving seat with a persistent hawkish Fed, as if you alluded earlier to. But the Russia sanctions is still a wild card, and China's zero COVID exit is a huge unknown variable that could swing either way. How do you see the oil market playing out over the coming new year?
Well, I think you pointed to what are the major forces that will determine what happens in the market, and it's the interplay between those. I mean, who would have thought that COVID would have such a big impact continuing on the oil market, but it has in China. I think President Xi Jinping has just the other day said that reviving the rebound of the Chinese economy needs to take precedence. And with the lifting of the lockdowns, if China demand comes back, that will certainly tighten the market because that's been a big chunk of demand that's been missing. The other side of it is, of course, the power of interest rates. And it's no surprise that higher interest rates, slowing the economy, would bring down the oil price. When we saw the beginning of the global oil crisis in the late autumn and early summer of 2021, the world was growing at 5.9%. In 2023, we think the world grows at 1.5%, and so perhaps even lower. There's some indications if they keep the pressure on interest rates. And that will clearly be a depressive fact on commodity prices. And I think that's the main reason we're seeing prices down now. If China comes back, market tightens.
Let's come now to OPEC. OPEC's 2 million barrels per day cut in October has proven to be the right call, despite much noise to the contrary at the time. The next scheduled meeting is in July. Given your oil market outlook, do you foresee the group needing to meet much earlier to cut further and deeper?
Of course, it was really an OPEC plus cut in production, but it was mainly done by a couple of OPEC countries, mainly the Gulf countries, and it did anticipate a weakening market. I think there's very experienced people in the Saudi Ministry of Energy who have been through a number of cycles and knows what happens when the world economy slows and interest rates go up and what that does to demand. What happens between now and July, or whether there'll be a meeting, I think it won't be. I don't think there's a long-range plan. I think it'll be very responsive to what's actually happening in the marketplace. And we've talked about uncertainties: China, Russia, interest rates, the global economy. I think they'll be watching it very carefully and will seek to respond to it. I think it's made more complicated by the price caps and the restrictions on Russian oil. And I think Russia would be very happy to see OPEC Plus cut production for its particular situation.
Given the sanctions and the changing trade flows, at what point Russia becomes a drag rather than a boon for OPEC?
That's a very thought-provoking question. Because at the center of OPEC Plus is the strategic relationship, the dialogue between Saudi Arabia and Russia, and the dialogue of the other Gulf countries with Russia. But I think Russia's situation now is so particular, and it's not just guided any longer by what does the oil market look like, but by the political needs of Russia at this particular time. I think it probably does complicate decision making in OPEC Plus, moves a lot of the decision making out of or at least the Russian side moves out of the economic assessment of the market and more towards political assessment. So I think in that sense, it complicates the position of OPEC Plus as long as this war goes on.
Finally, let's discuss U.S. oil production. Following a sharp downward revision in November, the EIA has raised its forecast for U.S. oil production for 2020 through 2023 to about 12.34 million barrels per day, surpassing the 2019 record of 12.32 million barrels per day. Despite this, do you foresee, Dr. Yergin, a notable deceleration in output growth from the U.S. shale fields to eventually set in?
Well, I think that the oil fields have strained under the same pressures of supply chain that other parts of the economy, in terms of services, in terms of steel for pipes, in terms of people actually who work in the fields, and that's actually been a constraint. And then you have the capital discipline, which is the mantra among shale producers. But I think that they'll respond to economic, to the price, but I think in kind of a moderate way. It's interesting. I was just at a meeting with the U.S. Secretary of Energy where we presented a report on technologies that the oil and gas industry is pursuing and thinking on energy transition. And the message from the administration is still, please increase production and investors give a little more room to companies to produce. So I think we'll see continual growth going into 2023 unless we're in a very bearish price environment.
Dr. Yergin, thank you for taking the time and coming on the show. It's always a pleasure to have you on.
Thank you.